In this video, we're going to talk about Imperial Petroleum, trading under the ticker symbol IMPP. At the moment, the financial market is very volatile, especially for the growth stocks or the penny stocks, and we have to be careful about which securities to buy, as well as the security and the timing of our trades. This video is going to cover the recent price actions and the technical aspects of the stock. Before the video begins, a quick heads up that my analysis is based on sessions already completed, and it may not take into consideration the latest events when this video is uploaded. If that is the case, I will make follow-up videos to reflect them. With that being said, let's begin with today's topic. During the most recent trading session, the stock decreased to $3.91 before closing the trading day at $4.25. We should pay attention to the $3.90 level nearby because it was tested 2 times before, making it a significant level to watch out for over the short term. Over the past 30 days, the trend of the stock has clearly been bullish because the stock is now benefiting from the real-world events and meeting a significant increase in demand for oil exposure. The stock recently created new highs and is now retracing after the recent spikes. There is real possibilities that the stock will retrace even further, but at the same time, we have to keep in mind that for this kind of stock in particular, the window of opportunity is limited, and the demand may only remain at the current level for a relatively short period of time, counted in weeks, or if we're optimistic, if I can say this, in months. From the perspective of a longer time frame, 6 months and above, the trend of the stock has been bearish for the most part, but the real answer is that it's been very volatile with very low lows and very high levels. I don't think that the stock will keep declining and that it will probably enjoy positive momentums as long as the demand for oil and gas securities remained. When we look at the price trend overall, it's been speeding up and reversing at the same time, since the recent events caused the stock price to go up, and this is expected to go for at least another few weeks, as long as the supply of oil and gas remains volatile. We have to keep in mind that the volatilities may also play against us, and going in the stock like this, we really have to keep this factor in mind. The trading volume of Imperial Petroleum has recently been 104 million shares versus the average volume of 67 million shares. Over the previous 52-week period, its price fluctuated between 40 cents and $9.70. The market cap of Imperial Petroleum is currently at $31 million versus an enterprise value of 0. Of course, it's not at 0. This is probably because we currently just don't have this financial data yet. So, the difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst the market participants, asset value may be impaired. At the end of the day, it remains an estimation of the market every single time it publishes its financial statements, so it's less reactive than a market cap and often more lenient for growth stocks. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is the expectation of the market that a company is able to generate more profit or to have more growth than another company, partially because it has a better management team, a stronger brand recognition, a bigger online following. It is what makes a company unique and worthy of our investment versus an alternative. In other words, it's not a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount. The market cap is lower than the enterprise value if the enterprise value includes a big chunk of the goodwill. And if the company goes to liquidation, the goodwill would be completely depreciated, and we would be left with potentially less assets to distribute to shareholders and debt holders than the balance currently on the financial statements. When we compare the current price to the historical price fluctuations, the stock is 783% higher than the 1-month low, 783% higher than the 3-month low, and 783% higher than the 52-week low. On the options market, which gives a hint on the market sentiment about where the stock price is likely going to head toward, the implied volatility here is 326% versus a historical volatility of 336%. Typically, the consensus is that we should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment, and not just a short-term trade. There's obviously a lot of exceptions, since many great companies are also mostly held by retail investors. But that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price goes lower. Sometimes, when there are significant short interest in the total volume, this is a sign that there's an organized shorting operation going on. The current short interest is actually 0% of the total float, according to the financial data, and 53% of the total transactions come out of the dark pools. Overall, my opinion on Imperial Petroleum is bullish overall, because the world events are going through a cycle that is favorable for the company. The maximum exposure I would recommend is 1 to 3% of your portfolio. And for the immediate term, my recommendation is to buy the stock, considering the recent spike in demand for the company. I would recommend to separate the allocation in batches of 10% of your allocation, so that you have enough room for later purchases. In the current market environment, I think that we should be careful about taking positions in the financial market in general, especially when it comes to equity market. Over the past decade or so, the financial market has been living with the help of newly created capital from the quantitative easings, which resulted in the increase of asset prices and the corresponding collapse of their yields. Of course, the low interest rate also contributed to reinforce that phenomenon because the financial sector would first of all see its profit margin squeezed, which will in turn keep the returns of other sectors low as well. At the same time, the market doesn't represent the real economy, and the real economy often doesn't get reflected in the prices of their own securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. And I want to say that fundamentals sometimes doesn't play that much of a role at all. If the asset prices only depend on the fundamentals, then their performances in Northern Hemisphere would have been more than mediocre, because things have mostly been stagnant over the years, ever since the last economic recession. A few things can explain why asset prices managed to remain high during these years, despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their local economies. But because that money is distributed to banks and expected to be loaned to businesses, and that there aren't that many opportunities in the real world, the money went into the financial sector to buy up assets. Of course, the QEs are wrapping up in many countries, so for the next couple of years, it's not going to be the main driving force to keep the asset price high. But it's compensated by the arrival of new capital from different regions in North America, because it's still perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be a sustained phenomenon over the years to come. The last phenomenon is the creation of artificial bubbles that are either supported by the real market trends or completely fictional, to allow market participants to play the game of hot potato and to either generate profit or to safekeep their capital. Of course, the people who end up with the hot potato lose money, but that's another story. The EV sector in 2020 is an excellent example of this. Nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially in Asia. This means that the market is expected to see its volatility increasing over time, which will provide opportunities to make a profit or to incur losses depending on the timing and risk management of those portfolios. Another thing to note for this period of time is to be very careful with having short positions. Usually, it's already more risky than having long positions because losses are not limited. And with the increased involvement of retail traders, I believe that the stocks being shorted will have a higher probability of getting squeezed, and this will occur randomly, which will result in potentially massive losses. We're also observing very often people will choose to rush in positions not necessarily because the fundamentals are convincing, but because there is a buildup of demand in a specific stock and that people will pile in to ride the gravy train with the rest of us. This kind of behavior is highly risky and may result in heavy losses as well. It's worth pointing out that in 2020 and probably in 2021 as well, the financial market has never presented that many opportunities, but it's also during this period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. The positions should also begin small so that there is an opportunity to average down later. Typically, the growth stocks would take about 5 to 10% in my portfolio overall, and each and every one of them represents maximum 1% of my portfolio. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.